If you're 60 or older and you're receiving Social Security or living on any type of retirement income, pause for a second, because something in Washington just moved that could affect how much the IRS ends up taking from what you receive. Most seniors still haven't heard anything about it. Bernie Sanders has stepped in, and what he said on the Senate floor has raised alarms on both sides of the aisle. Right now, a proposed IRS rule tweak is working its way through the process quietly. No loud headlines, no primetime explanation, just behind-the-scenes policy shaping that could take thousands from retired Americans, money they earned and, in many cases, already paid taxes on. This involves possible changes to how retirement withdrawals, pension payments, and Social Security benefits are documented, reported, and potentially taxed as soon as next year. Sanders isn't staying quiet anymore, and honestly, you shouldn't either. Because here's the part that almost never gets explained plainly. Seniors who learn about developments like this early can often protect their income before changes lock in. Seniors who don't may only realize what happened after a tax bill shows up that's far larger than expected. In this video, we'll break down what this proposed shift could mean, what Sanders actually said, and the 3 steps retirement-focused financial professionals are urging anyone over 60 to think about right now. You spent decades building this income. Don't let a technical policy adjustment quietly shrink it. Tap the like button so more seniors see this while there's still time to respond. Let's get the word out. And before we go further, keep this in mind. This is not about politics. It doesn't matter whether you've voted Democrat, Republican, or avoided politics completely. What the IRS does affects every retired American, no matter your party. So take a breath, focus, and let's walk through what's really happening, because this is one of those situations where missing the details can cost you real money. Let's start with Bernie Sanders, since his comments are at the center of the discussion and many people are asking what he said and why it matters. Sanders, the longtime independent senator from Vermont, known for decades of advocacy for working Americans and retirees, recently came forward with a blunt warning about the direction the IRS appears to be taking. He's never been shy about strong opinions. For years, he said the things other lawmakers avoid saying. What's different now is the level of attention, because what he's pointing to could hit millions of older adults living on fixed incomes. What Sanders described in plain terms is that the IRS has been steadily reshaping the way it reviews, tracks, and potentially taxes retirement income streams, especially the types of income seniors rely on the most. That includes Social Security benefits, 401k, withdrawals, pension income, IRA distributions, and even some annuity payments. These are not extra earnings. They are the financial base retirees built through decades of work. And changes developing inside the system could alter how that income is evaluated and how much of it you ultimately keep. Now, let's clarify something, because there's a lot of confusion online. This is not about the IRS suddenly sending agents after seniors or cracking down in some dramatic way. That's not the situation being described. What's happening is quieter and in many ways more impactful. Administrative shifts in how retirement income is categorized, analyzed, and cross-checked. And when a system becomes more technical and more layered, the people who get hurt are usually the people without daily guidance, those who don't realize the rules changed until they're already paying for it. To understand why this matters, we need some background. For decades, the taxation of Social Security has followed rules established in 1983 and later expanded in 1993. Under those rules, up to 50% of benefits can become taxable once you cross certain income thresholds, and up to 85% can become taxable at higher levels. Here's the problem that almost never gets enough attention. Those thresholds were never indexed to inflation. Not once. When the numbers were set, they reflected the economy at that time. But today, after decades of inflation, higher living costs, and rising benefit amounts, far more retirees cross those lines. That doesn't mean they're wealthy. It often means the threshold stayed frozen while the world changed. That slow squeeze is commonly called bracket creep, and it has been quietly pulling more seniors into higher taxation year after year. The worry now is that additional IRS adjustments could add another layer of complexity to a system that is already hard for the average retiree to navigate. And complexity almost always works against regular people. More complexity means more mistakes. More mistakes mean more penalties. More penalties mean more dollars, leaving retirees' pockets and going back to the government. That isn't a conspiracy. It's how complicated systems tend to operate. Sanders is one of the few major voices openly calling attention to that dynamic. One key area involves provisional income, which is the calculation used to determine how much of your Social Security becomes taxable. It includes your adjusted gross income, any tax-exempt interest, and half of your Social Security benefits. If reporting rules tighten or definitions shift, more seniors could accidentally cross thresholds that increase how much tax they owe. And for someone on a fixed income, an unexpected IRS bill isn't just annoying, it can mean cutting necessities like prescriptions, groceries, or utility payments. The impact is real. Another major piece is required minimum distributions, or RMDs. If you have a traditional IRA or 401k, the IRS requires you to begin taking distributions starting at a specific age. That age has already moved due to laws like the Secure Act and Secure 2.0. The basic concept is simple. Taxes were deferred, and eventually they come due. But the interaction between RMDs, Social Security taxation, and Medicare premiums creates a chain reaction many retirees never see coming. For instance, a retiree begins taking RMDs from an IRA they've held for decades. That withdrawal increases income. The higher income causes more of their Social Security to become taxable. Then, if income crosses Medicare thresholds, Part B and Part D premiums can rise due to IRMAA. One required withdrawal can trigger multiple financial hits at once. If the IRS refines how those numbers are tracked and matched, the room for mistakes shrinks, and the financial consequences grow. Sanders has argued this layered pressure shows how policy has failed to modernize for the realities retirees face today. He has supported efforts to reduce or eliminate Social Security taxation for lower and middle-income seniors. He has also raised questions about how enforcement resources are used, especially after the IRS received additional funding through recent legislation. A major concern is whether enforcement ends up landing harder on average Americans, while higher income individuals use complex structures that are more difficult to examine. Historically, lower and middle income taxpayers have sometimes seen similar or even higher audit rates, partly because their returns are easier for the system to process. That can create a world where ordinary retirees face more scrutiny than people with far more complicated finances. So what can you do right now? That's the most important part. Retirement-focused financial professionals generally start with one core step. Know your provisional income today. Calculate your adjusted gross income. Add tax-exempt interest, then add half of your Social Security benefits. If you're near the $25,000 threshold for individuals or $32,000 for couples, you need to watch your planning closely because crossing those lines can increase how much of your benefits are taxed. One strategy often discussed is Roth conversions. Moving money from a traditional IRA to a Roth IRA means paying tax now, but future qualified withdrawals are tax-free. And those withdrawals generally don't increase provisional income the same way, which can help manage Social Security taxation and Medicare costs. Another option is a qualified longevity annuity contract, or QLS, which can allow you to delay counting a portion of retirement funds for RMD purposes until later. There are also qualified charitable distributions, or QCDs, which let you send money directly from an IRA to a charity without it being treated as taxable income. Used correctly, these strategies can reduce overall tax exposure. Record keeping is another major issue. Keep every 1099-R. Track after-tax contributions using Form 8606. Keep documentation for Roth conversions. If your paperwork isn't right, you can end up paying tax twice on money that was already taxed once. And a quick warning, be alert for scams. The IRS does not call, email, or message you through social media demanding payment. Any message like that is a scam. Always confirm through official IRS channels. Zooming out, this is unfolding during a major demographic shift. Millions of baby boomers are entering retirement, and that puts strain on systems like Social Security and related tax rules. Policy fights are getting louder. Some leaders push for expanded benefits, others push for more revenue. What gets decided will affect retirement security for years. Seniors are also one of the most powerful voting groups in the country. Calling representatives, asking questions, and staying informed truly matters. Here's the bottom line. First, know your numbers. Second, look at legitimate planning tools. Third, get professional guidance if needed. Fourth, stay involved in policy discussions. Fifth, stay vigilant against scams. What Sanders highlighted matters because it shines light on a system that has slowly increased pressure on retirees through frozen thresholds and rising complexity. Whether you agree with him on everything else or not, the underlying issue is real. You worked your whole life to build retirement income. You paid in. You sacrificed. You deserve clarity and fairness. Stay informed. Stay proactive.